Have you ever wondered what actually happens in an IRS audit? Today, I'm going to walk you through a real audit where the IRS made multiple tax law mistakes at the exam level, and this is not that rare of an exception, okay? Tax law is hard, including for the IRS, and this is what real small business owners face when they're audited by undertrained auditors. We'll go through how you should approach this situation if it happens to you. And if you don't know me, I'm Jasmine DiLucci. I'm a tax attorney, CPA, and enrolled agent, and I started studying tax law in high school. My day-to-day is actually running my CPA firm and my tax law firm, but I started posting on social media and created a free tax law community after a decade of practicing tax law because real tax help with actual tax law should be available to everyone. So let's break down a couple of the core issues from this audit. The first mistake was that the auditor misclassified capital assets as startup expenses. But here's the thing, just because something is bought before operations doesn't mean that it is a startup expense. The law makes a clear distinction. Under IRC 195, startup expenses are things like supplies, training, or advertising. They're the kind of expenses you would normally deduct once the business is active, but if they happen before operations begin, then they get limited and often amortized over 15 years. And when I say amortized, that is just a fancy way of saying it is very slowly deducted over a long period of time. But in this situation, the taxpayer bought an asset which was purchased in anticipation of the business opening, and it was placed in service as soon as the operations began later that year. And the correct treatment was that the asset should have been placed in service when the business opened and then depreciated under IRC 168K with 100% bonus depreciation. Instead, the auditor labeled it as a startup expense and disallowed almost the entire deduction. Okay, and the second mistake was that the IRS auditor had no clue what a cost segregation was, even after it was explained to him. The taxpayer purchased a property for $650,000 and provided the full purchase agreement, which the auditor accepted and even included on the depreciation lead sheet. The taxpayer also submitted a qualified engineering-based cost segregation study, properly allocating the purchase price across 15-year property like improvements and 39 property, which is the main building structure. And despite having all of this, the auditor still requested additional invoices to support the 15-year property. Why? Because he didn't understand how a cost segregation works. And here's what most people know that the IRS auditor didn't know. First, the purchase document for the property and cost segregation study are the support, right? Second, the cost segregation study takes the total purchase price and based on engineering principles and IRS guidelines, properly allocates the basis across different asset classes. And three, you don't need to produce new invoices. And in fact, it would be impossible to have separate invoices for the 15-year property when the property was purchased as one asset. So what did the auditor do for the 15-year property that was properly depreciated with bonus depreciation? He denied it and said there was no supporting invoices for the work, not because there was missing support, but because he didn't understand the law. So what do these mistakes mean for you and how can you protect yourself? The first is understand the tax positions that you're taking, since you might need to explain them to your auditor. The second is simplicity in your return and records reduces your IRS exposure during an audit, since the IRS often doesn't do well with complexity, so only add it when there's a clear tax benefit and make sure you keep organized support for that tax benefit. Three, and finally, be ready to appeal your audit, which is of course what happened in this case, and it is the most common time for people to hand off their audit to me. Make the progress you can in exam, which is usually providing your receipts and support, and then it's okay, and in fact, it is normal to deal with the most specific or complicated issues with IRS appeals or IRS counsel. And if you want more real tax law from a tax attorney and CPA, then join my free actual tax law community where I do free monthly workshops, free Q&A, and even free IRS notice review. And for actual tax law from a tax attorney, subscribe.